Ladies and gentlemen of the crypto space, we're live on a Friday, March 27th at 11:50 a.m. The data that has been created, produced, the data that has occurred this week is simply extraordinary. Now, this is a week of change. This is a crossroads. This is a macroeconomic crossroads. Everything is at the inflection point of things occurring, decisions being made, limits being reached, boundaries being breached. And this is the fuck around and find out moment in macroeconomics like we haven't seen at least in a year. We saw it, and the move chart screams that. So today's story starts with move, as it often does, because it that really starts the entire cycle. Why? Move is volatility, and volatility tells us that things are occurring, that there's a significant change in price, and the move indicator is broadly the long end of the US debt market. So when the price of these instruments changes quickly, it means that actors, people, corporations, central banks, and nation states are making significant decisions that are changing the price of these long dated US debt instruments quickly. And as we very well know, these instruments are used as money. And we'll digress as needed if folks ask questions. Obviously, the difference between money and currency and whatnot. But what's pertinent is this chart not only ripped the week before, it double ripped and it breached moving averages. But this rip is absolutely epic. The last time we saw a blow up in the move indicator like this was March of 2020. It was worse in March of 2020, and the cumulative volatility was obviously greater through 2022 to 2025, Q4 2025, because we were at obviously higher levels. But this delta in such a short period of time is greater than what occurred in 2023. In 2023, that was the banking system blowing up, March of 2000, excuse me, March of 2023. That was Silicon Valley Bank. And I don't whitewash, I tell it as it is. When that bank blew up, if it was allowed to unfold organically and the liquidation of its balance sheet occurred in order to pay outstanding obligations, it would have had knock on effects. So that event in 2023, which we see here basically where this price scale shows a base more or less a 60% rip, not from the moving average, but from bottom to top, that was 100%. That would have taken down the entire financial system because that would have been that would have triggered cascading liquidations across the entire banking system. So that is one example of a macroeconomic event displaying itself on this chart, but there's multiple. Clearly, we had September of 2024, and there was a nice rip at the beginning in Q1 of 2025. But this rip is much bigger. So everyone thought they were in the clear. All us crypto investors and all us, everyone investors, because we'll actually look at NASDAQ today as well. Everyone thought they were in the clear, especially with the move getting down to the 50s. And then the administration does what parts of the political body do caused an event. And this event is obviously the ongoing war and the disruption of commodities, particularly energy, which is completely ongoing. And as Lagarde has pointed out, the ripple effects will take years to settle, years to be felt throughout all the affectable and affected parts of the economy, the global economy, which is every nation state. An absolutely monumental move. Let's measure this. From trough to peak, 106% in a very short period of time, coming off an extreme low. So, what's the difference between now at 106% and 102% back in March of 2023? Back in March of 2023, the financial system was already on edge. The financial system has was experiencing the volatility already. So everything was already crushed. So these couple of years later, things finally started to cool down. Things finally started to roll over and settle and find their base. And all of a sudden, 106% rip to the upside. Definitely epic and disappointing and frustrating and delaying of cyclicality. So, from a business cycle perspective, there's nothing's going to occur right now. There's going to be no bottoming of a business cycle, even though we see PMIs and other indicators doing what they're doing. You're not going to see an expansion when the move indicator rips like this, because the move indicator, as we've discussed very clearly, disrupts the entire underwriting process because the price of money dictates the terms of lending. And when the price of money does things like this, the terms of lending pause, everything halts. Everyone is told to sit down, shut up, and wait because the terms have to change. The terms have to accommodate where the price of money will be in a period of time. Think in terms of quarters, 3 months, 6 months, 9 months, a year. You can't give out terms on lending unless you have a decent sense of what the price of money will be in the short and midterm future. So that's going on right now. So this is why this indicator that I always talk about is a forward-looking indicator. So if this is occurring right now, as of right now, nobody has any idea what the hell the price of money is going to be in 3 months. Once this thing finally starts to cool down a little bit, then you start to get a sense. Then the underwriters start to get a sense of the pricing of things in a quarter or 2 quarters, but not right now. So right now, the volatility will bleed over into equity markets, will bleed over obviously into the crypto space, and especially real estate, which is completely stalled yet again as mortgage rates go back up. Especially now, everything is frozen yet again. So that's certainly disappointing after years of waiting for increasingly bullish market conditions. You're not going to get it. Absolutely not going to see bullish market conditions for, as of right now, an unknown period of time. Like if this rolled over and it held like a down here in the 60s, 70s, or in the 80s below a 50 SMA on the weekly, but it didn't. Everything blew up. So DXY is back at 100. 100 is just further confluence uh, along the same storyline as nobody knows what's going to play out. The 100 is obviously a very significant psychological threshold. Above 100 means something completely different as compared to below 100. So I did post shortly ago, many things on X. One of the more interesting things is the complete contradiction that macroeconomics is printing compared to what the current United States administration wants to do from a policy standpoint. And that is probably one of the more interesting things to talk about. Maybe it'll be a short couple of statements and we'll go back to the charts. But that contradiction is quite extraordinary. That could literally create the scenario where the entire policy goals of a sitting administration don't get achieved. One, or two, jawboning occurs. That's clearly what's occurring. The administration is doing the jawboning that the Federal Reserve did through the Biden administration. I posted that earlier. And they're going to see how susceptible markets are to administration jawboning, which is quite unprecedented in many regards. But we're at the point where the Federal Reserve certainly gets involved in economic pressures and the story that the general public consumes, because that's really what drives markets in so many regards, sentiment. So if the administration is joining jawboning efforts, all right, that could have some interesting, unprecedented effects. I think the general sentiment right about now is that those effects of administration jawboning are muting. They're becoming less and less effective as the macroeconomics becomes overarching. So you see the dip in oil when some headline comes out that tensions are easing, but then it shoots right back up because the move indicator blew out. So macroeconomics completely overshadowed and will continue to overshadow all jawboning efforts. So that puts the entire political situation and economic situation in a complete contradiction. So in so many regards, unprecedented is a word that we use a lot. And this is once again unprecedented to such a degree where there's a phrase, a cynical maximalist is what I am. And that's what I use to try and understand the best I can the likeliest potentiality for the future of global economics, considering how perverted things are from an economic standpoint. It's the end game of of continuity. Bear with me. This is the end game for continuity. How do you keep the wheels spinning? The system is so extraordinarily fragile at so many points of inspection. You have a disruption of 5, 10, 15, 20% of energy from an oil perspective, and that's not even the more notable things like helium and stuff like that, things that pass through the Strait of Hormuz. So these small scale disruptions are truly monumental in magnitude. 5% of helium gets disrupted. That disrupts the entire chip manufacturing, and that plays into everything from computers to vehicles and just the downstream products, what helium is used for in varying manufacturing processes. So that's why the knock on effects are just unprecedented. Um, and this is clearly an entire conversation where I'm starting. I'm not talking about capital management. I'm not talking about assets and what to own. This is first and foremost the most important thing that we do on this conversation is understand what the hell is going on. Then and only then can you make decisions about capital management and what to own and why to own it. So we go over to NASDAQ, and NASDAQ clearly is a very popular investment. NASDAQ, the United States stock market, the tech sector. And that, from the general public's perspective, that's what they look at. That's what they see on CNBC and the headline news. They see these types of data points, and when Nasdaq breaches these kinds of levels, this turns all the talking heads into bearish types of conversations. This is a breach of the 50 SMA on the weekly. That's not trivial. Last time we saw that was March of last year, about a year ago, and that was a big breach. And that's just along the lines of the more structural things we've seen since 2022, and that was tightening of policy, tightening of monetary policy, which started very clearly in the data at the end of 2021. That took over a year to recover from. The 2025 dip in tech didn't take that long. It took about 6 months, give or take. This is a precarious set of candles holding the weekly 10 as resistance, punching the weekly 50 to the downside. That is pretty unique, if I might observe. A lot of, because the wicks, it means there's a lot of buying pressure, but the overall net was selling, which would make sense because NASDAQ is part of 401ks and the passive flows. So you got this constant passive bid of everyone that just dumps their capital week over week into these fucking disgusting indices. But the actors that have control over the investment portfolios are on net selling it. So these wicks are quite telling of where this economy is. The only reason these indices go up and to the right is because of these passive flows. These aren't investment vehicles. They're dumping grounds of capital, where capital is dumped because nobody has any better place to dump it, which really contributes to my theme, how I define these indices as overpriced pig shit. I mean, pig shit could be is very valuable from a fertilizer standpoint. You could use pig shit and grow fields of corn. Doesn't mean I want to invest in pig shit. I think there's better investments than pig shit. And then we obviously start the entire conversation of investments. Better. What is better? What is the net result and the goal? All right, a couple of good other technical pieces of data. So with the volatility today, Bitcoin dominance is expressing itself to the downside. So the non-Bitcoin space of crypto is on the verge of a lower low. In fact, it did print a lower low. This is the lowest low for Bitcoin dominance since last year. And last year, we were above the weekly 100. So now we are below the weekly 100, which is a very different structural position. Lines on the chart mean something because everybody looks at them. So if we're below the weekly 100, this is quite meaningful. The trends continue until capitulation. We're nowhere near capitulation. We haven't even started whatever the hell is going to play out. But this trend is clearly Bitcoin rolling over relative to the quote unquote altcoin space. I'll use that word just for simplicity, even though I find it quite derogatory. Maybe better used as the crypto fintech space. That's clearly a rolling top. This is such a weak chart presentation. So it's the breakdown, the rolling top, and then falling through an MA. So if anything screams continuation to the downside, it's this chart. So 58% with the 200 SMA to the downside at about 53, 54%. That is the expected trajectory. I don't think that's a destination. My 2 cents, that lines up nicely with 2027 and whatever the hell plays out towards the end of this year and into next year. But generally, I expect the 200 SMA to flatten, and I will eventually get that breach of the 200 SMA to the downside as well. It's not that Bitcoin doesn't perform better into the future. It's just that the rest of the space has so much of a potential to grow significantly beyond the capitalization of Bitcoin that it overpowers this chart from a data standpoint. So Bitcoin dominance should trend down over time. It's a very interesting chart. I expect so there's been two cycles more or less from an altcoin perspective, 16, 17, and then 20 and 21. And over the last couple of years, we got our 22, so our bottoming in 22 from a Bitcoin perspective. But I expect, generally speaking, the next cycle is to present a very different shape. And that plays into the way I've described the non-Bitcoin space as fintech, as crypto fintech. And to understand the next wave that will present on this chart, or at least think about it and speculate on what shape it could produce. 16 and 17, there was no fintech. 2021 was the first instance of fintech, actual businesses. So, whatever next shape we produce, there's going to be a much more established business presence and understanding of what these businesses are. And businesses have a very different footing. They present themselves very differently when investors look at them. So, folks looking at the crypto fintech space now, what do they see? They see basically distressed businesses. So, eventually, there will be capital inflow into these businesses. They will mature, the products will be consumed, and they will be integrated into society. So, the investment landscape will mature. So, this, therefore, the structure of this chart in the coming years should logically present very differently as compared to what occurred in 16, 17, 20, and 21. Bitcoin falls into more of has monetary characteristics, but it falls into the cash category of from a capital management standpoint, whereas crypto fintech is more of the investment category. You're looking at value versus growth. You're looking at balance sheets. You're looking at cash flow and everything. The entire space is in distressed territory. This is going to be quite fascinating looking at this chart. I don't want to speculate on bottoms in this chart. We're finally getting to the point where we're seeing a structural top with the breakdown, the rollover, and the breach of the MA. But where my mind is at isn't even where bottom is. Bottom, I'm not too interested. I'm interested in where the top is, the next top, 2028. So I like to think about what the structure will be between 2028 and 2030. That's probably going to be much more interesting than anything we've seen thus far in 16, 17, 20, and 21. The other two charts that are the most interesting that I posted about was others, Bitcoin denominated. So this is an inspection of the altcoin space and Bitcoin denomination. So we could easily look back in hindsight and see the events in 2020, the rollover of the altcoin space in Q4 2020, as compared to what occurred in 2025, October 10th, as a divergence event or divergent event. And the recovery of that divergence is what's most interesting. It was just such a remarkable recovery. The sell-off, the liquidations, but then the capital was able to reflow into these assets and reprice them back to relatively consistent or normal pricing for the period of time, such to produce this absolutely remarkable wick. So what's most pertinent about this chart is it's outperforming. This chart's up 2.13% today. This is the non-Bitcoin part of crypto, Bitcoin denominated. So crypto is significantly outperforming not only the broader crypto space today, but also Bitcoin as well. Very meaningful chart. And the greatest correlation that I see is this chart compared to central bank balance sheets dollar denominated around the world. So it seems like the magical word liquidity is ever pertinent. What's pertinent, what is liquidity? It's currency capacity, currency availability, the availability of excess capital for investment purposes. So you have the breakout through the 100 SMA on central bank balance sheets, the retest, and now we're figuring out the retest. So this is quite interesting from a short-term perspective. On the short term, this is, do we see continued sliding prices across US equities, across the crypto space? And short term easily gets swallowed by midterm. So the midterm perspective is clearly seen from a monthly perspective. So on a monthly perspective, you could see easily some continued depreciation across risk assets, but heading into the end of the year, the powers that be at these monetary, uh, at these currency institutions, not really monetary, is up and to the right, which makes sense because interest on debts need to be paid and that entire conversation, yada, yada, yada. At some point, the powers that be intervene to stabilize currency supply. And where do you see the currency supply being put under pressure? You see that in the dollar indices, with the highest level inspection being at DXY. The dollar is scarce. And when there's disruption in energy supplies, people scramble for dollars, not people, corporations and nation states. They accumulate and hoard dollars because they need to make sure they have a capacity to acquire commodities, natural resources, and energy supplies. So when you see the central bank balance sheet constrained like that or getting drawn down and the DXY pushing up, it generally means there's a shortage of dollar currency supply, which is putting pressure on foreign currencies, which plays into the entire psychological calculation that you could assume. If foreign currencies are increasingly weak and the dollar is increasingly strong, that's not what literally any country on the planet wants. They don't want to see their currency excessively weak or depreciating because they have a capacity to quote unquote print their respective currencies. What they want is a stronger currency, at least cyclically. So, what has the world not seen for a very long period of time? A cyclical weakening of the dollar. So, all of it comes back to the overarching conversations that we've had over the years where I expect a cyclical depreciation of the dollar. And when I say cyclical, it's probably more or less secular, like a 10, 15-year lower high, lower low series of depreciative legs on the dollar relative to foreign currencies to reprice, or on the dollar to reprice foreign currencies higher. So this is all moving in the opposite direction. So basically, macroeconomics is being disrupted today to such a degree that it's running contrary to what every foreign government wants, every foreign central bank wants, and certainly what the sitting administration in the United States wants. The sitting administration wants a strong depreciative leg for the dollar. They want to depreciate and devalue the dollar because that turns the United States into an exporter versus an importer. That's the simple equation, what relative currency value does to a nation state. And that is not what's occurring. So, what you see playing out today, ladies and gentlemen, is a macroeconomic contradiction to political policy. But it's not just domestic US policy, it's basically global policy. If you follow some of the other macro guys, you start to see some strength in foreign stocks and foreign commodities, Brazil and India. And that's what all these countries want. They want at least a period of time where respective markets appreciate relative to the United States because you have such a concentration of capital in the United States. It's nice to spread it around a little bit. The whole world is in sync with that mindset right about now. It's how we get from where we are to that macroeconomic reality. That's the inspection we try and make when we look at these data points. So we get to see in real time what levers foreign governments and foreign central banks and US domestic, what levers they pull in order to attempt to stabilize things. The first lever they're always going to pull is the jawboning. They're going to try and talk their way through markets, massage markets, and affect markets because that affects the flow of capital. And the flow of capital plays into relative currency valuations. They're not really going to be able to affect relative money valuations, which is primarily the US debt market. So that is why that is often talked about as the ultimate source of truth. What was that post I reposted shortly ago? Yes, the Kobe SE letter. So the bond market's screaming rate hikes because the energy sector is pushing price inflation of consumable energy, predominantly gasoline, and but that is the knock-on effects are everything, all the way down to helium tanks for birthday parties. But helium is used in manufacturing processes, so the knock-on effects are obvious. So if the bond market, the U.S. debt market, is screaming rate hikes are what is needed in order to stabilize economics, man, that just screams the contradiction that we just mentioned with the administration policy. They want the dollar lower. They want the US to be a manufacturer. And rightfully so. We expatriated everything over the last 20 plus years. So it's time for some cyclicality. It's time for a secular change in the structure of capital flows, international capital flows. So we get to see what what policies various countries enact, first and foremost the United States, in order to achieve these policy goals. Bitcoin obviously getting hammered is below 66. My line in the sand is more or less this green line. I don't know. Is that decent line? Lines on the chart are still just lines on the chart. But I draw it here because it's a cluster of candle body closes, particularly the second week of November 2021. You could see that red candle body close. I guess that more or less is the prior month as well, or the prior week as well. So the first 2 weeks of November both had a candle body close at this level of 65,705. So I see that as a decent level for inspection. Clearly, you have a cluster over here as well at 59. So, but you also have some decent confluence because there's a fair amount of candle body opens and closes around that line here in 2026. So while we can draw some lines over here, and those happen to correlate with the weekly 200 moving average, which is interesting. And it also you got your cluster of candles in this remarkable compression and consolidation we experienced in 2024. So the two areas of inspection that are going to be interesting over the next couple months are certainly the orange circle, which is still in play until we get a meaningful breach below 65,000. Like if you start getting into the 60s and you start to see like 58 and change, you start to see them breaches through the weekly 200, then you're probably going to be thinking in terms of this cluster here, something like this box. I don't know, something like that. At least that's what my eye goes to, which is what I meant by this green circle, something like that. So right now we're still below the weekly 10, still have a fair amount of meaningful congestion. Still see a little bit of wicking. Maybe it holds, maybe it doesn't, but that's what we're going to see over the next couple of weeks. That's where we're at from a Bitcoin perspective. Otherwise, all narratives remain the same. Q2 2026 is coming up. Aerodrome, velodrome convergence. Yield basis hybrid pool still coming. That's going to always be interesting. Yield basis negligibly green on the day. Curve expressing continued weakness, 21 cents. These are not short-term inspections, ladies and gentlemen. I don't give a shit about 4-hour charts, 1-hour charts. I don't care what it does in the short term. That's not the point. Point is structurally, it's had its lows. This is at beaten down, broken down prices. These are not periods of time for to have any expectation of prosperity. These are periods of time for austerity, ladies and gentlemen. This is where some of my social media commentary comes back to accounting, where the best thing to do is to focus on how we manage the books, how you manage capital management structurally, and you prepare for good times. This is not a time to expect the good times. This is a time to prepare for the good times, ladies and gentlemen. Buck 70 on convex. I have been tempted a little bit for maybe some IRA liquidation, migration of capital over to maybe a convex. That's the first time I've said that in probably a couple of years. Folks have no need to skew towards VECRV, but at these prices, a decent sized convex position can be acquired. Do prices go lower? Whoopie do. That's not the point. The point is the accumulation of assets, rule number one. So that was an interesting couple of, well, you see it all the time. It's buy the blood and oh, goes down further, buy the blood. And you can only buy the blood so much, but that's not the point. The point is that's a broken statement. So now I could digress maybe into investment thoughts and how to, that part of capital management. You're not buying blood because you're not thinking in terms of total net worth, which is a waste of mindset. You're thinking in terms of what assets do you buy? Folks think in terms too much. You have saved capital and you want that amount of capital to go up, number go up. Save capital go up in price? I don't know. But the point is, we are what assets we own. We are what assets we choose to own because that's an expression of our psychology. It's an expression of our mentality. It's our expression of our macroeconomic understanding and our financial aptitude, how well we understand businesses and the potential for the future of businesses. So price go down is an opportunity to potentially own more of an asset. And you don't think about whether something's going to go down more. You just respect the rules. So if you want to own something and you have capital, you buy something. You have respect rule number 4. Never fuck up the cash position, ladies and gentlemen. Never spend too much. Always have to be able to pay your bills. So that plays into cash flow. So most people's cash flow is in terms of work. All right. So if you make X amount of dollars and you have X amount of extra dollars, or you spend X amount of less dollars, then you have X amount of dollars for investing and you buy assets. Rule number 1, buy more assets, ladies and gentlemen. And I don't like debt. I don't do debt. The only debt that the captain has is cars, but the cars can always be sold. And don't screw yourself getting into a financing arrangement without respecting depreciation because you'll find yourself underwater. You never want to find yourself underwater where you have to pay to sell something you own. That's an absolute ridiculous situation. Otherwise, lease vehicles, the vast majority of top brands, you can exit your lease, you could sell your lease, and at worst case, you just default on your lease and you get a hit on your credit. Whoopie do. Who gives a crap about credit and debt, in my opinion? You don't want to use credit or debt for anything. That is a last resort. That's my opinion, and I reserve the right to have that opinion. Debt is bad. Now, you'll talk to a real estate investor, of which I know many, and debt is interesting because you depreciate things, and these are all deductions, and they have all their real estate accounting tricks to basically cancel out almost all tax obligations from a corporate and personal accounting standpoint. Absolutely fascinating. You talk to a real estate person and they're like, "Yeah, I had to buy this house at the end of the year because I could write it off and I didn't want why give the money to the government when you could own an additional asset." So, we're not here for that kind of conversation. Fortunately, it's a little bit simpler. That is not the most simple conversation, albeit it's not too complicated. The real estate investor's playbook, but it does require a certain level of capital. Definitely need a couple 100,000 to think about most of those types of moves. Where most of our capital conversation and considerations are probably in the thousands. Hopefully, folks are a little bit beyond the hundreds, but the thousands are considerable moves, and they will compound and accumulate as the cycles proceed over the next 1 or 2 decades. So those are the time frames you guys have to think in mind with regard to capital management. They will suit almost everyone well. I think the real estate investing is more for a different generation, an older generation. I think the digital landscape is the best investment landscape there is by far for countless reasons. Okay, let's do it. Let's do the commentary and see if I can help you guys out with anything on your mind. If you're on X or on YouTube, please feel welcome to ask any questions. I will get to each and every one of them. To me, does move index ripping matter if Fed is the buyer of last resort of treasuries? Yes, it does, because I'm not too interested necessarily in what the Fed does. I'm much more interested in what international banking does. And when the move indicator rips, the underwriters are a deer in headlights and they are paused. They are put on hold. They are told to stop doing whatever the hell they're doing and wait for markets to make a decision. It's not necessarily the what everyone wants to hear. Everyone wants to hear the Fed. The Fed, the buyer of last resort. The Fed does the QE. The Fed prints the money. Money printer go burr. The United States of America has produced a little bit over 10% of the total dollars in existence. The vast majority of dollars were not printed by the United States. That's probably the most contrarian statement that I could make. but it is real. And that is what the Eurodollar market is. Meaning we'll pretty much never have liquidity crunch of treasury markets muting the effect of volatility. Well, we are in the middle of a liquidity crunch. We see that because the DXY is going up. We see that, and that being caused because energy prices are going up. And when energy prices go up, people scramble for dollars. And by people, I mean corporations and governments and so on and so forth, because they need the dollars to buy the energy. So, what the US at some point structurally will want to do and probably needs to do in order to maintain the status quo is to flood the international market with dollar supply. So if the vast majority of dollars were not printed by the United States, rather by the Eurodollar banking system, maybe the United States has a structural policy to increase international dollar supply uh, from domestic U.S. means and sources, 15%, 17%. And, they somehow get some trillions of dollars into the international system by a acceptable means. And by acceptable means, I mean that's accepted by the international community. So I don't know what that policy would be, but that's probably where things are at from a crossroads standpoint. The US has not meaningfully contributed to global dollar supply in a long time. We provide the money for global dollar supply, and that's by the Treasury Department. And the Treasury Department is responding to supply and demand. So the amount of debt, this is my contrarian take, the amount of debt the United States has been issuing is to meet the currency demand of the world. And the world needs US money in order to print US currency, if that makes sense. But that's the story. That's how I understand things. Treasury is a producer. They produce a product that the world is demanding, US Treasuries, and the world uses those US Treasuries via the international banking system, the Eurodollar market, to print US currency, if that is acceptable and makes sense. Going to the beach tomorrow will be nuts. It's going to be lovely. I look forward to hopefully a beach weekend. I love going to the beach with the family. There's this place down here that has middle neck clams, not little neck. The little necks are the little ones. I like the big fat clams, not oysters. I'm not too much of an oyster guy, but I like the big clams. It's my favorite. You mix that with a pizza pie on the side and 2 hours of sun. Now you got a weekend. So there's a couple of states in the U.S. where you could have a good time like that. Plenty of places along the coast in Texas. I don't know. I wouldn't do it in California. It's a mess over there. Certainly Florida. It's a good place to do things like that. Good activities. Definitely the East Coast, Virginia and whatnot. Very good point. What are we doing this weekend? That's more important. What's most important in capital management is finding reasonable ways to pass time. The advanced manager of capital is more interested in the processing of time than capital markets, because our understanding of these capital markets allows us to have projections, foresight, and ideas about the future. The hardest thing about that is waiting for that future to arrive. So we need to allow time to pass uh, reasonably. Guy can't have the anxiety, can't have frustration, got to have a balanced budget, can't have excessive debt, can't be spending too much, got to be able to pay the bills, can't fuck up the cash position. Rule number 4. And once you're able to do all of that, you still need to respect rule number 1: own more assets. Arrow, much a pleasure, my friend. Hope everything is well. Sir Joe, present and accounted for. IF in the house. Long week, long day, factory. Am I right, boys? Well, good code this week. My company's doing interesting things. I hope it's a good year. Different industries are having different times. Some are good times, some are bad. My industry happens to be telecommunications, advertising. I'm a software engineer, and the product that we make is really centered around, well, advertising of digital products, be it applications or digital fintech as well, and games, and that we use those types of products, and the advertisements are monetized, and that's not the worst industry to be in. It's a pretty good industry. Seems pretty stable for the time being. So I will continue to have a capacity to do these streams because things are stable, thankfully. Debate of paying down loans of 40 acres versus just holding cash is ever present. Ever present. Loans, cash. Folks often think about cash as a missed opportunity. If you're sitting on cash, as you could have owned something, and that something you own could have gone up in price. You could have bought something at a cheap price. This is why everyone must have in mind what is a good quantity of assets to own. Because the reality is, you could always own more of something. So if you could always own more of something, that's not a goal. Therefore, you have to choose. And this is very subjective. Everyone individually has to make a choice, a grown up choice of what is a reasonable quantity of something to own. And we have to live with that. And then it goes up 10x on the money, and you're like, oh, I wish I bought more. But the reality is, if that's the first thing someone would think, it's also the wrong way to think. You could have always bought more, could have always bought at a better time. And that's why I came up with the rules, overarching rules that allow me to recognize when something is not a great idea. Look, you're sitting on cash. If you're sitting on cash, you're like, oh, I should have bought something. I could have bought something. But then that could potentially interfere with rule number 4. Can't mess up the cash position. There's probably definitely room for more rules. Got to be able to pay the bills, like X amount, not X amount of months, like an emergency fund. It's you got to be able to pay the bills. So I guess for a period of time, maybe that does qualify as requiring the definition of what is an emergency amount of capital for X amount of months or X amount of bills, so on and so forth. That's why debt's such a big deal, because if you don't owe money, how much do you have to come up with? And that, ladies and gentlemen, fine, maybe that's actually a rule. I've defined over the years something called wake up money. How much money you need to spend just to wake up in the morning to pay the car bill, finance or lease, what have you, the gas bill, so you could use your car, food, property tax, so you could stay in your home, rent, mortgage, still got to pay the tax. Well, that's called wake up money. So as long as you have wake up money under control for a period of time, you could sleep. You are no good to anyone, especially yourself, if you cannot sleep. So that's why a lot of my topics have been about health and wellness, maybe. That's a very important thing in capital management. You will not make the best decisions possible managing capital if you're not in a good place mentally. If you are not sleeping at night, you cannot be in a good place mentally. You need to get adequate sleep and recovery. You need to get adequate stress and training. You need to be healthy and well in order to manage capital well. Hope that helps. Steamers, oh, you're killing me because my diet in the morning, I tend to I exercise. I don't go to gym every day anymore. I used to. I was in sympathetic overdrive for quite some time, and I'm finally got my body into a parasympathetic state where I could take a nap in the afternoon and I could sleep 8, 9, 10 hours at night if I wanted to. But I tend to exercise and sauna in the morning fasted. So by the time it's like 10, 11 o'clock, I'm like, food. So it's about 12:45. I had a little something, but right about now, when you say steamers, I'm like, yay, food. I want food. So you're killing me, dude. What I would do for a pot of steamers are like 3 dozen middle neck clams and or a thin crust gluten-free pizza or something, man. Oof, I don't know. It's food time for the captain. I'm getting hungry. IF, what's happening tomorrow? What did I miss? Baked clams is also one of my faves. Baked clams is absolutely lovely. Clams are lovely. So I'm with you on that one. Tomorrow's just it's Saturday, and hopefully, folks have a capacity to decompress on the weekends. I know all too many folks that are financially repressed, working on the weekends. I hope and wish more folks can relax on the weekends, and that is such a critical thing. You need to be able to relax and decompress and take care of yourself and spend time with your kids. And that will allow you to be a better manager of capital. Everything I talk about is related. It's funny that way with regard to humanity. As I said, you can't manage capital well if you're not in a good place mentally, and you're not going to be in a good place mentally unless you take care of yourself physically, unless you eat right. It's a big deal. Ah, dude, killing it with. Oh, that's the best. I mean, all you really need is a good spot and hopefully a backyard. Hell, I grew up in apartment buildings in New York, and in hindsight, there's probably some good places for some chairs down out back and just sit in the sun. And I don't know, everyone you could find that place to rest and relax and have a good time anywhere if you really wanted to. So home may be the best vacation spot. And if you make it your best vacation spot, that's clearly the most economical vacation spot, no doubt. All right, ladies and gentlemen, we went over the technical details, the macroeconomic situation. We understand the volatility that's playing out. This shit is going to take some time. This is not a time for prosperity. This is certainly a time for austerity. This is a time for not fucking up the cash position. Rule number four. This is a time for preparation, where you prepare for good times. Make sure you have a plan with regard to accounting. Talk to the people you need to talk to. Ask the questions you need to ask. The beauty of it is nowadays we have AI. So you could ask, I mean, literally, AI is just crazy where it's at. So you can have the most extraordinary conversations about decisions that you have to make, or the least decisions that you should be making, and things that you can do. You could do things today that you could not do a few short years ago. And you could do it yourself. You could do lawyerly things yourself. Certainly do accounting things yourself, but lawyerly things yourself allows you to structure and plan things from an accounting perspective. So plan and prepare. Follow the rules. Rule number one, own more assets. Rule number two, don't overpay for assets. Rule number three, fuck you, pay me. Rule number four, never mess up the cash position. I remind everyone of the five business of crypto: foreign exchange, credit, derivatives, liquidity financing, and liability printing. There are only five businesses in crypto. Anything in between is a derivative of something, probably a duplicate of something, probably something that's unnecessary, probably something that's already been done before. So we fall back to lendiness. The businesses that have survived 2022 are the most likely to survive and thrive into the future because they have the trusted brands. And the market has the memory of a goldfish. Drama of the past rarely lives too far into the future. People forget, and all they remember is something that survived. Still no yard, but Florida beats New York City, no doubt. Oh, the climate, everything is different down here. What a lovely state. I just got this short note. Plan ahead. Plan ahead. What do you think it? Plan ahead. It means plan ahead. Plan ahead. Plan and prepare, ladies and gentlemen. Spend the weekend. Work with AI. Plan and prepare for the future because good times are always after difficult times. And what we know about nature, nature is cyclical. Therefore, humanity is cyclical. Therefore, economics is cyclical. Friday, March 27, 12:51 p.m., 117 people made it to the end of the stream and are all now that much more rational because of it. I appreciate each and every one of you. Get some sun, rest, relaxation, exercise, sauna, good hydration over the weekend. I will see you guys and gals next week. Till then, peace.